Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss the GDP, the looming recession, and more misleading headlines from Fox News. Today is Thursday, February 27th, 2023. I am Byron Lazine, and the hot sheet starts now. Welcome back to the hot sheet. If you joined me on the live stream yesterday, thank you for doing so. Myself and Tom Toole did a follow-up live stream right here in the live tab on the BAM YouTube channel on following up with leads. Of course, that was at 3 p.m. Eastern. But if you want to watch the replay, it is uploaded. Hit the like button on this video and consider sharing it with someone who wants a 24-hour look back on housing. We've got a really juicy 3 topics today. GDP news just came out. We're going to get into that first. We're going to talk about Vanguard's recession prediction and how real estate has mixed into that. And then we're going to update the big story of last week, that this Biden administration rule, as Fox News likes to put it. I've got more information there, and it's been a hot topic all over, Twitter and other places. So we're going to update that first. Let's get into this GDP information that just was released this morning. U.S. GDP, gross domestic product, rose at a 1.1% pace in the first quarter as signs build that the economy is slowing. Okay, gross domestic product rose at a 1.1% annualized pace in the first quarter, which was below the 2% estimate according to CNBC. Slumping inventories and general decline in private investment held back early year gains. So this is actually right. This 1.1% is right where the Fed, Jerome Powell, has said he'd like to see GDP. He said we don't want to be above 2% like we were in quarter four. We want to be below 2%, but we don't want to be negative. Negative means you're starting to get really close to that recession. So 1.1% in quarter one would be right kind of where Jerome Powell wants to see this thing. Inflation was higher than expected in the corner, with the PCE price index rising 4.2% against the 3.7% estimate. But we know that inflation is slowing. We've talked about that a whole bunch as new information continues to come out. Growth slowed considerably during the first 3 months. These interest rates were the biggest factor on this slowing economy. Gross domestic product, which, if you're not familiar, is a measure of all goods and services produced for the period, for that quarter, for the first 3 months. Okay. The Commerce Department reported that this was a 1.1% annualized pace for the first quarter. These things sometimes do get revised, but that's where we're seeing it right now. They were expecting the 2% growth. So the growth rate followed a fourth quarter, which GDP climbed 2.6%. Okay, so well over the 2% kind of barometer there. And we had a year where we saw 2.1% increase. So really strong fourth quarter. And then now in the first quarter, we've seen this thing slow down. Now, high inflation and so slow growth. And they were talking about this morning I saw on CNBC. I read an article about this on Wall Street Journal as well, where this can sometimes be considered stagflation. Okay, we haven't seen anything we haven't seen stagflation since the late 70s or the early 80s in the US economy. Okay, so high inflation, slow growth would be considered stagflation, right? If you've got high inflation, you typically would need to have high growth, but we're starting to see slow growth, but still high inflation. High inflation hasn't come down. If inflation comes down and growth comes down, that's going to be where the Federal Reserve wants to see us. But we've seen inflation come down, just not fast enough maybe to catch up to this slowing economy. Okay, Jeffrey Roach, chief economist at LPL Financial, says the U.S. economy is likely at an inflection point as consumer spending has softened in recent months. The backward nature of GDP report is possibly misleading for markets, As we know, consumers were still spending in January, but since March have pulled back as consumers are getting more pessimistic about the future. They've pulled back, but I mean, people are still traveling. Let me know in the comments. I know, you know, a lot of people that are planning on spending money over the summer months, that have things planned, that are not slowing down. So love to know what you're seeing in your community. If you're seeing the same, are you in a community that attracts tourists? Is it up? Is it down this year? All right. Just a little bit of other economic news that would correlate to GDP. Jobless claims totaled 230,000 for the week ending in April 22nd. That's a decline of 16,000 below the estimate for 249. So the job market, what makes the FOMC's decision really easy is if the job market breaks, but it hasn't broken yet. It's still considerably strong. The GDP report comes as the Federal Reserve is seeking to slow an economy burdened by inflation that has been running at its highest level in more than 40 years. Okay, so we're still awaiting what they're going to do in May. We have a strong jobs market, unemployment rate at 3.5%. So it's going to be very interesting. That hasn't made their job easier. And it's likely, I think Logan Motoshami always says it on Twitter from Housing Wire, it's likely that the Fed is going to break our job market to be able to fight this inflation just because it hasn't come down fast enough. And they do want to avoid that stagflation word mentioned here in the CNBC piece. Okay. The housing market downturn is why we view a mild U.S. recession in 2023 as most likely. This is according to Vanguard. So Vanguard is saying recession is coming, and real estate is why it's most likely. We do have a Charleston realtor, William Burton. Spring tourism season and events were as busy as ever in Charleston. Record passengers at Charleston International in March. So there you go. I still see a lot of people traveling. We did see when that last CPI report came up, that plane tickets were up. So that would make sense. Okay, so let's switch over to recession here. Housing market downturn is why we view a mild U.S. recession in 2023 as most likely. This is according to Vanguard. A little story here. History tells us that Federal Reserve's inflation fighting playbook starts with the U.S. housing market. This is a piece by Lance Lambert and Fortune. It goes like this. The central bank begins by applying upward pressure on mortgage rates. Okay, we've seen that. Soon afterwards, home sales fall. We've definitely seen that. Total home sales have fallen. And home builders begin to cut back. We saw that in quarter four, and now we're seeing optimism and some strength, certainly in home builder stocks here in quarter one and in quarter two. That causes demand for both commodities, so lumber and concrete, and durable goods like refrigerators and doors to fall. Okay, we did see that. Okay, those economic contractions then slowly spread throughout the rest of the economy, and in theory help to rein in runaway inflation. Right? We know that CPI number makes up 34%. That CPI number, shelter housing, makes up 34% of all inflation. It's why Barry Sternlight from Starwood Capital believes that, hey, rents have already come down. Inflation's not as bad as everybody's making it seem. There's the debate there because the rental numbers are lagging. All right, so this is exactly what we saw last year, the picture I just painted. The Fed started jacking up the rates, the mortgage rate spiked, the U.S. housing market slipped into an old school housing downturn, which the hardest punch being out west. Okay, so out west has seen the most significant decline in home values. Fast forward to now, and the U.S. spring housing market appears to be stabilizing relative to its free fall in the second half of 2022. The free fall in most markets was not that dramatic in prices. Certainly in total transactions, we saw a free fall. Okay, we've seen, transactions drop by over 30% in almost every single market. However, the uptick in new home sales isn't enough to stop the economic headwinds created by the housing slump. So we're seeing new home sales, we just reported that this week, are up, slightly, but up. And this is how Vanguard sees it. Okay, so since World War II, Doing a little history here on the hot sheet. Hit the thumbs up if you like the history lesson. Since World War II, declines of greater than 10% in the annualized rate of investment in housing construction and improvements. Okay, so declines of greater than 10% for investment in construction and improvements since World War II, or basically we call that residential fixed investment, have coincided with recession on all but two wartime occasions when defense spending propped up the economy. Okay, in the last 3 quarters of 2022, declines in such investment hovered around 20%, wrote Vanguard economists in this recent report. Okay, so anything greater than 10% of a drop in residential fixed investment, besides two like major wartime, recessions or cause recession in all but two wartime occasions, rather, when we were really spending a lot on defense. Okay, so heading forward, Vanguard expects the housing market downturn to help push this U.S. economy into a mild but not deep recession. The housing downturn is part of the reason why we view, and this is a direct quote from Vanguard economists, the housing downturn is part of the reason why we view a mild U.S. recession in 2023 as most likely. Okay, I've been cautioning everybody on the hot sheet to make the hay in May, to make the hay in June and July, because quarter four in 2023, the end of quarter three in 2023 could look like 2022 or worse. And you don't have quite the spring market this year going into that as your padding. So it's really important to take advantage right now if you're a real estate agent or reliant on the housing market. Okay, this is a chart from Lance Lambert from Fortune sourcing U.S. Bureau of Economic Analysis. We're passing through a housing recession. Quarter over quarter change in private residential fixed investment, GDP, i.e. housing activity. Okay. And you can see that we haven't had one of these since the very beginning of COVID when things stopped. And then prior to that, certainly that 2008 timeframe, the great financial crisis. But we are starting to pass through, and we'll see where the end of this housing recession ultimately ends up. We have seen a bounce back up in home prices. That doesn't mean that the housing recession is over. Okay. Housing economists still believe we're in a housing recession, despite us seeing the first month where home prices have corrected nationally. Okay. So two different things there. This is a housing recession is tied to this private residential fixed investment GDP or total housing activity. Okay, that chart's down below for you in the daily download, where we put all of our source links and charts for you to grab. If you sign up once, you get them every single day. All right, so by the time national home prices bottom later this year, now we know month over month they've bottomed according to multiple economists and charts. But when we're talking about, they're talking about this year over year bottoming. Okay. So Vanguard expects U.S. home prices as measured by Case-Shiller National Home Price Index to drop 5% on a year over year basis. Okay. Now, if that happens, in order for that to happen, because we just reported yesterday on Case-Shiller's number. Okay. Case-Shiller year over year. Or we did it. I'm sorry. We did it on Tuesday's hot sheet. So if you want to check that out, go ahead. I'll pull up the number. I know we had a 0.2%. I'll pull up the exact number from Case-Shiller. It's slipping right now, but we still have an increase. On a year-over-year basis, the index rose 2% in February, down from the 3.7% the prior month. So you can see that 3.7 year-over-year Case-Shiller number has come down now to 2%. But from 2% to negative 5% is a pretty significant gap. Okay? So Vanguard believes that what they're tracking forward, according to Case-Shiller data, is that we're going to bottom on a year-over-year basis at negative 5%. The home price index to drop 5% on a year-over-year basis. Okay. So in order for that to happen, the national housing market would need to slip back into correction mode on a seasonally weaker summer and fall months. Because we know here in the spring, we just saw a month over month increase for the first time in home prices, and that we're expecting to see that the next couple of months. So quarter three, quarter four, we'd have to go back into correction mode, meaning home prices starting to drop. I'm a believer, and I've said that a bunch on these streams, that is a scenario that I would put categorize as more than likely to happen, where you do see seasonality increase in prices, but you could see a seasonality drop in quarter three and quarter four in prices. Not 2008, not some type of bust, not some type of 26% drop, but a couple of points drop month over month. So, in fact, Vanguard thinks that after the housing market helps push the U.S. into this recession, because of this year-over-year drop in prices that they're projecting, that the housing recovery will then help drive overall economic recovery as affordability normalizes. However, housing should still act as an economic stabilizer, wrote economists at Vanguard. That will eventually pull the U.S. housing market, which has been limited sales spring as mortgage rates sidelined what would be home buyers and sellers, out of a recession. So it's going to eventually pull us back out. Okay, they often say that housing makes up 17% plus of total GDP. It's very, very important. Yesterday, we went through how important it is to people's finances who own real estate. We had that chart that showed the difference between people who own stocks and their home that they live in, and what that does for their finances. Okay, so to wrap this Vanguard outlook on recession up, our researchers believe U.S. housing activity will be driven in the next couple years. Okay, so this is what they believe is going to drive housing activity in the next couple years. Number one, structural undersupply of homes that's prevailed since the 2008 global financial crisis. Number two, I would agree with that because we're still undersupplied. Number two, robust demographic trends and favorable sentiment towards home ownership. People want to be homeowners. And number three, strong borrower fundamentals and high equity cushions. We're not giving loans to anybody. Those are 3 bullet points I may put out in an email newsletter. I may certainly get out to my database of reasons why the housing market is going to be overall strong over the next couple of years and probably into 2005. The structural undersupply of homes that's prevailed since 2008. If you're following the hot sheet, you've got a whole bunch of charts from the daily download that reflect that. The robust demographics and trends and favorable sentiment towards home ownership. People want to own homes. The millennial generation overwhelmingly wants to own a home. And number three, the strong borrower fundamentals. Okay, we're not giving loans to everybody. We have an update on these loans here coming right up on this Fox News Biden administration decision. And then the high equity cushions. Okay, so recession, according to Vanguard, likely. It's going to be a modest recession, not a deep recession, and that housing will have a lot to do with putting us into said recession and also pulling us out of said recession. I think if the Fed gets their way and they break the job market, which they've been unable to do as of yet, then the recession is a foregone conclusion. Okay. Fox, the most trending topic that we covered last week and has been all over social media. And I've seen people beat me up on social media. I've seen a bunch of people just take this Fox News headline and run with it. We mentioned in last week's hot sheet, you can go back and look at some of those replays, how insane their headlines were about, and they're continuing with these headlines. If you actually just Google this FHFA new rule that goes into effect May 1st. So I know most lenders will tell you it's already in play. It's already been happening. But it officially goes in for all Fannie and Freddie loans May 1st. If you Google it, most of the headlines are Fox News. Like, they are just all over this, and they're continuing with these absolutely psychotic headlines. Okay. Senate GOP slams perverse Biden rule, forcing people with good credit to subsidize high risk mortgages. So it sounds like a totality overall, like we're taking money from the people with good credit and giving it to the people with bad credit. And that's not at all the full picture or the full story here. Okay. It's a very complicated change in the ruling for Freddie and Fannie, which is why a lot of lenders have pushed back just based off of the complication making their job harder, but they haven't necessarily pushed back for the reasons that Fox News is holding on to. Okay. So I'm not going to read the Fox News article, because if you're getting your real estate information from a place like Fox News or any of these mainstream media outlets, then you don't know what you're doing. Okay. It's a terrible move. Okay. I mean, Fox News, if we're going to get our real estate information from them, they just paid somebody off like $1 billion in the same week that they lost the number one host on cable television for prime time per the ratings. I'm not taking a side here. I'm just saying they don't seem to know what they're doing. Okay. So why would we get our real estate information from them? I'm going to switch over to yesterday's report from Housing Wire. I first guessed this last week. I called Fox News's headline insane, and now Housing Wire is backing me up with their report yesterday when I first guessed this. Okay. Correcting the LLPA false claims. Okay. So it's been in play for months. Exactly. Lenders say this has been going on for months because the loan delivery date is May 1st for, yep, absolutely. That's absolutely correct from the Let's Talk Mortgage Pro. Love to know some more of your thoughts on this. Let's Talk Mortgage Pro in the comments. Okay. So Housing Wire backing me up a week later. I first guessed that these claims by Fox News were insane. I'm going to read directly here from Housing Wire. There's a lot of false claims to dispel. But make no mistake, updates to the GSE's pricing framework are a tough pill to swallow for the mortgage industry. I'd love to know from the mortgage lender that we have in the comments here if that tough pill is more on the complications of it, or what your thoughts are in regards to that statement. Okay, so social media is probably abuzz with claims that the FHFA's new loan level pricing adjustments, LLPAs, loan level pricing adjustments on conventional mortgages favor buyers with bad credit over buyers with great credit. A 620, here's the quotes from a Fox News segment making the rounds on social. So this is quoted from Fox News in this Housing Wire piece. A 620 FICO score gets a 1.75 fee discount, and a 740 FICO score pays a 1% fee, reads one screenshot from this Fox News segment. Here's the thing. This is what I said last week, first guessing it, and this is what Housing Wire is saying and publishing. Here's the thing. That's not true. Exclamation point. Okay, so very bold in saying, no, Fox News is out here saying things that are not true. What a surprise. They just paid a Billy to get, or 700 milli, whatever it was, to say things apparently that, or settle something that apparently was not true. Okay. We're going to break down the FHFA's latest loan level pricing, most of which are already in effect, just like we heard from Let's Talk Mortgage Pro. So once they were announced in January, they already went into effect. Okay. And in January, it was really about, okay, if you're going to do a second home refinance or some type of an investment loan, it was going to be more expensive to do those. To me, that made sense. We're in high inflationary times. We want to slow down cash out refinances. Don't know if the Mortgage Pro would disagree with me on that making sense, but it made sense to me to make some of those scenarios a little bit more expensive. Okay. We've this pricing grid, which I've shared, I'm putting it back in the daily download. And we updated this on, I think, Friday of last week, but I'm going to put it back in the daily download again today. Before we go to that, it's definitely on complications, right? So it's making everything's complicated. High FICO, 680 to 780 are being hit harder with 5 to 15% down. That's what we're about to look at right now. Keep in mind, MI is super pricey under 680. So low FICOs will still get hit harder overall due to mortgage insurance. And you can see here who's getting hit the hardest. This red section here, where you have modest down payments, but still good credit. Okay. Still good credit over here. Let me just highlight what I'm saying when I say over here. This range that she said here, like that 760, 7 to 760, but modest down payments. That's where you're getting hit the hardest and actually seeing an increase. Okay, great credit, and surprisingly, lower down payments or higher down payments has no impact at all. Really great credit, 780 here at the top line has no impact whatsoever. Okay, here's where you have some of the improvements. These lower, lower credits, and you get the biggest impact when you start to see higher down payments. Okay, so that's the chart that you want to look at. Those are the exact changes. It's not an all for one or a one for all. These are the new versus old for purchases. Where it's higher, it's in red. Where it's lower, LLPAs, it's in green. You still have a lot of green when you're looking all the way here to the right. It's surprisingly I'm sorry. Yeah, when you look over to the right, you're seeing all benefit on the LLPA chart. Okay, I've got another chart on this that will show in just a second. Okay, so just to explain, the pricing grid contains credit bands that correspond with upfront fees based on mortgage product, loan to value ratio, occupancy, etc. You can see the grid tops off at 740 credit score, meaning that anyone with a FICO score of 740 would pay the same rate on fees as someone with a credit score of 780. Under the current model, risk-based pricing has been consistent. Generally speaking, the lower the credit score, the higher the LTV, the higher the upfront fee to mitigate the risk. The new model tweaks the risk-based pricing formula in significant ways. Here's the new pricing matrix so we just looked at that on purchasing loans, which goes into effect May 1st, but we know it's been in effect really since January. It's been or more than a month, according to Housing Wire. This isn't the grid the GSEs use, but it does show where changes are. Major props to they give Matthew Graham of Mortgage News Daily credit for creating this chart. Yes, this chart was from Mortgage News Daily. Here's another chart down below. Okay. So Rebecca Richardson, who's a loan officer at Mortgage, has an example in which sales prices of the home is $400,000. And the scenarios are credit scores of 740, 700, and 660 with corresponding down payments of 3, 5, 15, and 20%. 3, 5, 10, 15, and 20%. Okay. So her quote is, people with great credit are not getting penalized, nor are they subsidizing low credit buyers. She said this in a LinkedIn post, and that's primarily because people who were in the down payment cheat code zone, where they were putting more than 15% down, but less than 20%, had their terms subsidized by cheap mortgage insurance policies, which basically gave them the same terms as somebody who was putting down 25%. So to her, these changes are more about bringing things in line where the actual risk is based off of the down payment. Okay, so you can see here, 660 credit score is paying more than the credit score of 700, 740 when 3% down. They're paying more in a scenario of 5% down. They're paying more in a scenario of 10% down. They're paying more in a scenario of 15% down. And they're paying more in the scenario of 20% down. Okay, in every single scenario, the 700 credit score is also paying more than that of the person with the 740 credit score. So the better the credit score, risk is factored in with this down payment. The better the credit score, the better you end up with the fees here in this new structuring of LLPAs. Okay. So why is the FHA making these changes? The pricing change is in line with the Biden administration's stated mission to provide housing financing opportunities to first-time homebuyers with lower credit scores and those in underserved communities. Okay, so that's been an initiative. FHFA is taking that initiative and then making these rules for Fannie and Freddie. Okay, so now I don't necessarily think this is going to solve, the overall housing issue, which is undersupply. This actually makes, you know, affordable homes more competitive in an environment where we don't have enough of them. So I'm not sure that this actually solves any problems. I first guessed that last week. I'll probably be historically correct on that assessment as it plays out. But for those buyers that are able to win a bid, they'll save some money on their closing costs, maybe upwards in that $400,000 example of $3,500. Our Real Mortgage Pro could fact check me on that. There are always going to be winners and losers when the FHFA decides to change the pricing matrix. In this case, a portion of good but not outstanding credit borrowers will receive a bit of shock, a couple $1,000s worth in some cases. Okay, so this policy should come at the expense of those who are. This policy could come at the expense of doing things the right way. This is now Director of Marketing at Thrive Mortgage. Could it come at it's a fair question. This is a major change for the industry and setting a precedent on moving away from a pure risk-based model, a risk for the FHA. Even the agency disagrees with that interpretation. Okay, so I think this is just harder work for the mortgage industry, and you do see the chart where it impacts people. Let's Talk Mortgage Pro says, don't forget, this only applies to conventional loans. FHA is still a good option for lower FICOs. Okay, so this is on conventional loans only, and they already made changes and announced changes on some of those cash out refis or second homes being more expensive there. All right. So that's your update on the changes to the LLPA. Let's get an update on where we're at right now at this moment with the 10-year. Okay. 10-year is back up over 3.5. So we were sitting closer to 3.4, which was a nice sight just a day ago. So we've really come up almost 0.1 here since yesterday. I would expect yesterday's trend of the 30-year fixed to crawl up again. We bounced off of that 6.5 we like to see in these times right now to 6.57. We could get back up over 6.6 today, according to Mortgage News Daily's 30-year fixed daily survey. So, and I know Let's Talk Mortgage Pro, local lenders might be able to get people a little bit lower than that. All right, big announcement for my hot sheet people. And Bobby, I don't know if we have a hot sheet code, but we're going to create one. I don't know if we have one. Bobby, which code should we use if we're gonna announce BAMX the hot sheet?
We're gonna use code hot sheet for the hot sheet.
Ready? Is it ready, Bobby?
It will be ready by the time this broadcast ends.
All right, we'll get it ready like right now because we're gonna put that into the comments. All right, so we haven't announced it on social media yet, but we have announced it in our email newsletter. A soft announce towards the bottom. We've launched our BAMX platform. Okay, this is going to be the go-to source for edutainment, education, and entertainment in the real estate industry. We already have courses on there. We have live streams. We have a private community. Everybody on the hot sheet is going to get a 15, Bobby, I don't know if you heard that, a 15% discount off of the annual subscription. Okay, 15% by using the code hot sheet. All right, that'll be good for this week. There's nothing like this. There's so many different courses out there on Instagram. An agent sells 2 homes and they have a course and they put it in their Instagram bio and they get people to buy it. There's so much overpriced paywalls from legacy media companies. This is a $10 a month product on the annual subscription, and we're giving you 15% off of that. Okay, so we've completely undercut everybody's pricing who believes that they have a great paywall product. All of our podcasts, all of our blogs, all of our content remains free. Everything when we're telling you how to do it remains free. When you get into BAMX world, we're actually showing you how to do it. So I know some legacy media companies that have rolled out some streaming stuff, and it's still just people sitting on stage talking. This is showing you exactly how to do it. We have Addy already enjoying the BAMX platform. So in our soft launch, Addy, you must have gotten on there. So we've undercut the pricing and then added 10x more value, which is the BAM way to do everything. Let's freaking give extreme value and not completely gouge people like you've seen on listen, if you just go on BAM and compare it to, $50 a month subscriptions, and BAM is free, by the way, the value completely blows it away. There's nothing close to it. There's nothing close to our daily content and daily shows. And I promise you, BAMX is going to over deliver in such a significant way for the price of a coffee a month. And I'm going to give you $15 off till the end of the week for all my hot sheet people. For the price of a coffee a month, 15% off for the annual. You got to sign up for the annual to get the hot sheet code. You're going to get access to BAMX. It's absolutely incredible. And we're really, really excited about it and what we're going to be able to do with that in the future. So I'll talk about it a little bit more tomorrow, because tomorrow's Friday.
And Byron, don't mean to cut you off, but if you sign up for BAMX today, Eric the Broke Agent is doing a live Instagram audit, the first live BAMX event. It's going to be a little bit later on this afternoon. So head on in there and add it to your calendar.
And so you'll actually put your Instagram into that live stream, and he's going to be doing live audits on the spot there. So, all right, that link is down below. Later today here on BAM YouTube, we have walkthrough at 5 o'clock. Walkthrough with Danny Deals and the Broke Agent, and a rotating cast of guests has been just incredible. Make sure and please consider subscribing to this channel. We are pouring a lot into this channel, and if you've been a consistent follower of the hot sheet, love to earn your subscription here on the channel. We got one more show on the hot sheet. That's tomorrow live at 9:30 Eastern, 6:30 Pacific time. And until then, toodaloo, folks. Toodaloo.